I met a dog walker that's making $1 million a year. You don't have to be a software engineer to do well. You just have to be at the right place, the right time.
If you look at the history of high inflation, only people who survive are the ones that have these side hustles and that they're actually able to take advantage of the inflation that's out there.
I found houses I could buy for $75,000 that if I had to rebuild them, it cost me $300,000. And I did all the math on it. And everyone said, Roman, that's a crazy idea. No. It was the best single real estate investment I made my entire life.
We are forced to speculate. So what are the best things to speculate on? What should we do with our whatever spare cash we might happen to have? And hopefully you do have some. And if you don't, probably need to figure out what to do about your spending. Welcome to the Best Half Show, the show dedicated to the big idea that the second half of your life can be 10 times better than your first, and also officially the best standing podcast and show in the world today.
Number one standing podcast.
Number one standing
Super
podcast.
Super excited about it.
Yeah, I'm not sure how long we can keep this innovation of ours.
It's unbelievable.
There's not really a big barrier of entry, but for now, this is, I guess, one of the many things that makes us unique is the fact that we're a standing podcast. And today we're going to be talking about one of your favorite topics, which is money, and how to achieve financial freedom. We're in a really interesting time. I mean, we've had inflation really since 1913, when these central banks started printing money. But I think we're in a time now where there is a lot of inflation. You don't necessarily see it as much in the figures, but anybody who's been to a grocery store or a restaurant, or you're even trying to hire some labor, has seen that the inflation rate is a lot higher than what's officially reported. Correct. And if you're sitting on a lot of cash, you are in trouble. You have to find some way to put it to work. We are forced to speculate. Yes. And so what are the best things to speculate on? What should we do with our whatever spare cash we might happen to have? And hopefully you do have some. And if you don't, probably need to figure out what to do about your spending. But assuming that you do have some spare cash, what do you do with it so that you can achieve financial freedom and all the things that we like to talk about?
Yeah. So Mark, let's just talk about, what does this inflation mean? We know that, for example, in the US, they're printing $1 trillion every 100 days.
Yeah.
To put that in perspective, that's more than they'd printed the first 100 years. So every 100 days they're printing. And from what I understand, that if you had cash in 2020 versus 2024, you've already lost over 20%. Can you just maybe explain what that means?
Yeah, and I mean, over 20%. And if you put it in T-bone steak terms, which you wouldn't because you're a vegetarian, but yeah. If you're not a vegetarian and you use steaks as your barometer, then you would have lost about 50%. These days, if you want a good strip loin steak is $12. It was $6 4 years ago. So,
well, that's a good one. I'll give you the vegetarian version. So I went to buy burrata, just one little thing of burrata. It's $20. I remember when I'd go to a nice restaurant and have a burrata dish for $20. Now just to go to the grocery store to buy the burrata, it's $20. So it's gone up quite a bit.
And they keep trying to gaslight us by saying, no, the inflation rate is only 4% or whatnot. And they think that if they tell you that, then maybe you'll believe it. But it really isn't true if you keep records of this stuff. So we have no choice. We're forced to speculate. We need to find some way to make our money multiply.
Yes.
And so, we're going to talk about some of the principles, I guess, some of the things that we've learned.
Yes.
What we've learned about investing. And maybe to start, we say, probably the best category to invest in, according to Warren Buffett, who said this, someone asked him at one of his annual events, where is the best place for us to put our money today other than Berkshire Hathaway stock? And he said, invest in
yourself.
Right.
And I think this is the most important thing. So here's what I know for sure. These are things that I know for sure. And we are not making any financial recommendations. We are not financial experts. We're just giving you some principles that have been really good to us. So one of the things that Warren Buffett said, invest in yourself. So for him, it was a Dale Carnegie course. And he said that one course really changed the trajectory of his life, because he says we all have to sell. We have to learn how to get up and present to somebody. For me, it was actually a course at Western, actually here on college at Western, probably the most valuable course I ever took at university. It's called speech. And every week we had to get up in front of the class and they gave us some weird topic. We did get up and present to people. So again, I think that the principle is invest in yourself, because your income can only go as high as your personal development. So your net worth will only go as high as your personal development. So I mean, I've seen this in my case, maybe you have too, but sometimes you get lucky and you have a really good high income year, and then it goes back to like where it should have been, where your personal development is. So it's like kind of like your body temperature. Like we know our body temperature is a certain temperature. You may have a fever, but it goes back to its normal temperature. So unless you're investing in yourself, your income can't grow past you.
Yeah, no, totally agreed. I mean, so speech is a good one. I've also invested in that. I've actually had personal speech coaches that have trained me, and for sure that's a great investment. I'm spending a lot of time these days on disruptive technology. I know you are too, right? So understanding where things are going next, where I guess I've made my wealth that I've made is really on betting on cloud computing really early in its cycle. Now it's maturing. But understanding disruptive technologies, understanding like where there might converge in the future. Like I want to be at the nexus of, let's say, AI and drones or something like that. Understanding where those are going and spending time like right now to geek out on what's happening with some disruptive tech, I think is a really good idea.
So I want to give you a counterpoint to that. So I've known Mark 25 years and you've always been a software guy. And I think the business model, the SaaS model is incredible business model. But I want to contrast that to last week. I'm in Palm Beach and I met a dog walker that's making $1 million a year. They have 3 employees, 2 little trucks running around, making $1 million. I met a bartender that last month made $35,000. So you don't have to be a software engineer. You don't have to be a tech guru to do well. You just have to be at the right place, the right time, the right industry.
I agree. But even there, I'd say that if you have an understanding of disruptive tech, you can do really well. So, a good story is 1-800-GOT-JUNK. Which has become a more than $100 million business.
Incredible. Yeah.
They just haul away junk, right? But they also invested in they invested in modern technology where other companies didn't. I read a story about a pig farmer in Iowa that made a huge amount of money because he was really early on sensors and AI and a whole bunch of things. So if you apply modern technology to backwards old industries, you can do really well. So I have no doubt at all that taking a modern approach to dog walking is brilliant because most people aren't doing that.
Right.
Well,
even what we're doing today. So in the old world, Mark, we'd be making cold calls to people and telling what we're doing. And now we don't do that. So we've invested in tech to create a podcast that people that resonate with our message contact us, right? So it's again, we're doing the same thing, it's just different tech.
Right.
So I think when we talk about building wealth, financial independence, number 1 is invest in yourself. Number 2 is invest in your business. And your investing in your business might be a podcast. It could be a website, it could be a blog, whatever it is. But so your best investments are really in yourself, in your personal development and in your own business.
I think everyone needs a business. I mean,
or side hustle they call them these
side
days.
hustle. Whether it's your main thing or whether it's a side thing, you just can't make money being a salaried person these days. And I hope I don't really screw myself because I like to build businesses with employees in it. And I'm proud of the many of employees that I've had that have gone on to build businesses. So I really depend on people who are willing to work for me and take a salary. That said, I'm pretty happy if those people stay in my company for a while, drive a lot of value for themselves, and eventually end up, having a business, or at the very least, a side hustle. If you look at the history of high inflation, which I believe we're heading into, so I believe that we have not seen the end of it. No. I think we have a little bit of a lull. But there's no way out for these governments. Like they have to do this. If you look at it, the only people who survive are the ones that have these side hustles, and that they're actually able to take advantage of the inflation that's out there. They're able to borrow, they're able to access capital, and they're able to buy real things with it, or they're able to get customers with it. Right. Like that's a great place to be. If you're stuck, especially if you're stuck on like a fixed income, if you're on a pension, right, you're getting wiped out if you don't have something on the side. Or even if you're a VP of blah blah, making $150,000 a year, so you think you're doing well, but your costs are going up by 9-10% a year,
At least.
your salary is going up by maybe 2-3% a year.
Right.
Maybe. Chances are it's not. You're getting nothing, and then you get a little bit of a 5% bump if, in 3 years.
Yeah.
You're not going to do well in this environment. You have to have something else going on the side. So I
Mark,
totally agree.
I agree with you 100%. Now, you and I are entrepreneurs. We start our own businesses. Now, not everyone has a skill set. Not everybody wants to do that.
Yeah.
So for people that don't have a skill set, but you have some economic means, or you can borrow money, maybe buy a business. There's a lot of people retiring right now, a tremendous amount. There's millions of businesses for sale and they can't find a buyer. So I think there's an incredible opportunity. And you can even buy business with very little money down.
Yeah.
So not everyone has this great idea and can start a business. I mean, that's really, really, we're talking about a few percentage of the population can do that. But I think a bigger part of the population maybe has a skill set to run a business or manage people, and they can actually buy a business these days. So
I think
it's another huge
idea.
opportunity.
Yeah, especially again, you buy a business and then you apply modern something to it. Like, let's apply modern management practices and let's go manage people properly. Let's go and find a way to hire better quality people. Let's invest in advanced technology. For sure, I'm a big fan of that approach. I think it's
find a way to improve a business.
Yeah,
I think
it's not what I've done. I mean,
we haven't done that, but I think I'm considering it. But I think a lot of people, that's an option to more people, and it's less risky because when you talk to people like, oh, it's really risky to start your own business. Yeah, it probably is. It probably is, and not everyone has a skill set for it. It's really hard. Like there's nothing easy about it. I love when Elon Musk says it's like looking at the abyss, eating glass. Like that's what it feels like a lot of times. Like it's really, really hard.
Yeah, it is. But so now that I think about it, I mean, I got my start in business. Well, first I was doing custom software development and literally going, maybe this is a big innovation, going in downtown office towers, knocking on doors saying, do you need any software done? Right. Probably the only door-to-door, software developer out there. But after that, where I really cut my teeth in entrepreneurship was in running a painting franchise. Actually, it wasn't a franchise. It started as a franchise. It was a knockoff of College Pro called Metro Pro Painting. And once I learned I had to pay 25% back to the company, I'm like, well, why would I do that? Why don't I do my own thing? So I created organized painting services, which for anyone who knows me is hilarious because I'm not very organized. I'm just organized. It's kind of a joke. But, I ended up making $36,000 in 4 months.
Wow.
But a lot of it was through process innovation. At the time, I didn't know what that meant. But we went from regular doing painting houses to doing custom artwork.
Right.
It's kind of a random thing that happened.
It's huge.
And end up doing really well. So there's these pockets everywhere, even in a really old school business like painting. And again, I was 19 years old.
Yeah.
I didn't really know anything about painting at all. I knew nothing about managing people. In fact, all my people quit on me. I had to hire a whole new team because I was so pathetic as a manager.
That happens in every business.
Yeah. Right. But as a 19-year-old kid, this was back in 1994, making, I made $36,000 in 4 months. So that's, equivalent to whatever. It's $130,000 a year back then. That would be $250,000 a year. Yeah. Today, there's pockets of opportunity, everywhere.
Yeah, there is.
So I actually like that idea quite a lot. I've built businesses, using a lot of venture capital. I mean, my first company, Eloqua, was bootstrapped for a while, but then I used venture capital. I'm not sure how excited I am about that these days. You lose control of the company, you end up owning a pretty small piece.
But those days you had huge costs. I mean, our servers cost us a fortune, or employees. But today, the next generation are going to be one person really mastering AI is going to build corporations. I mean, I'm already doing it. We're already seeing this happen.
I'm seeing
so you don't need to raise millions of dollars when it's you and a bunch of AI bots doing all the work.
Yeah, no, I agree. Yeah, so buying business is interesting, especially if you can find something that you actually are passionate about. I think that if you don't have a passion for dog walking, I wouldn't do it.
Right.
Or I've seen a number of models online, I've seen on X, here's how to run a property management business.
Right.
Here's how to run a painting business. Here's a breakdown of all the numbers. Here's how to make it work. I still say there's dark days in entrepreneurship. You got to do things that really excite you.
Yeah.
Mostly what I recommend to people who want to be entrepreneurs, whatever, is just go out seeking pain. Where do you find frustration? Where do you find aggravation? And if you can find a pocket of underserved people, that because they don't have access to whatever it is, this technology that they're, if you can find those people that have this problem, it's kind of what I recommend.
Yeah, and the harder the problem, the bigger the problem, the more money you make. So if it's a really difficult problem you're going to solve, you're going to make more money. If it's a simple problem, it might not be as profitable,
Right.
but a harder problem, you make more money. So Mark, let's assume somebody's made the investment in themselves. They've done all the personal development courses. They've made those investments themselves, and they've also invested in their business. They've put their capital there. But now they actually have to make actual investments in third-party things, maybe stocks or bonds or real estate. Where do you think people should start?
Yeah, no, and I actually had this problem. So I got like an exit from Eloqua back in 2007, and so I had a few $1 million and had to figure out what to do with it. Because before then I really didn't have so much money where I had to really think about allocation. I put some money into mutual funds or ETFs, GICs and whatnot, but it really wasn't enough. And of course I was running a company, so I really wasn't thinking about it. But then I actually got a bunch of money and had to think about it. So I reached out to a friend of mine in California and said, hey, his name is Orrin Hoffman. He's big, an investor, a very well-known entrepreneur there. What should I do with this money? He said, you should come to Silicon Valley. You should look at some angel investing. So I'm like, okay, I went to do that. And actually, a very interesting story is he's like, you should meet my friend Mark Pincus. He's doing something interesting with this little Zynga company, which at the time Zynga was 2 people. It was Mark Pincus and it was another guy that worked with him. And I missed out on doing an angel investment by like literally a day, which cost me a lot. But anyway, that got me started thinking about what do I do with this, right? What do I do with this money? I ended up giving a bunch to some investment advisors, here in Toronto. And then when the Bear Stearns thing happened, when that crash happened, and I called in and say, like, what's going on here? Like, do you know what's happening? And they didn't really have a good understanding of it. That's when I realized like I had to really take ownership for myself and figure out what's really going on and how to invest so that you're going to have financial freedom and even generational wealth. Like, how do you make sure that if you have children, that they're going to have enough money to be able to do what they want? So I started to really get interested in things like diversification, among asset classes beyond just stocks. Because remember, in 2008, it really looked like the sky was falling. Right. Turns out it was actually a great time to buy stocks back then, and real estate.
Yeah. That's very cool. The first time I was in a similar position, it was my first .com client, and we built a website for them. We had some success, and they give us stock options in a publicly traded company. Yeah. So I was able to sell those stock options, but it was in a brokerage account. And I thought, okay, so what do I do with this? Yeah. Normally, I'd only been buying real estate. So I picked, I think it was either 5 or 6 of top tech companies like Cisco, it was Dell, it was Microsoft, Intel. Like I literally took like the big 5 tech companies. And I literally did what they say you're supposed to do, just forget about it for 10 years. Right. And so I took the entire investment, put it in those tech stocks, and I waited like the 10 years you're supposed to. Yeah. And I called the broker and I said, hey, can we pull it up? How's it look? Because I'm thinking I did great because Intel was the number 1 chip company. Dell was killing. Like I picked the 5 winners. Yeah. And he's like, well, we had this thing called the lost decade. And I'm like, what are you talking about, lost decade? Yeah. He's like, I picked the 5 or 6 best companies. Like they're still the leaders. Right. Like their sales had doubled or tripled. He's like, yeah, the stock hasn't done that well. We call it the lost decade. I was so pissed, Mark. I'm like, never again. I'm going hardcore. Because real estate, I always made money because I knew how to do it. So it's interesting how sometimes we forget, even if you invest in the right companies, there's timing and there's seasons. And not everything goes up forever, even in tech. And even in real estate, I remember when I went to Utah for the first time in 2011 as part of every year I go for the ski trip. And I remember looking at the price of real estate and like my jaw hit the floor. I mean, they were giving, I called my wife, they're giving houses away over here. And that's because they had a massive crash of real estate in the States, including, so prices went down 70%. In some cases,
in Park City, Utah, went down 70%. Yeah. And so I was looking at comparing it to Blue Mountain, which is not a mountain. This is it's a hill. It's a little mosquito bite that's kind of just outside of Toronto. Yeah. And looking at places that were $2 million, $3 million there, equivalent to this place that I really like that was $700,000, right? Yeah. And but I think the difference is that we didn't have a big crash here.
Right.
Like the banks didn't fall apart in 2008. So even real estate, like I remember when Toronto, which is a famous bubble, right?
Yeah.
But
Yeah.
in the early 90s, I mean, it went down 70%,
Yes.
you know?
Yes.
So
it took 13 years to get your money back. So people in Toronto forget about that.
yeah.
Or they just, well, what do you mean? Like, no, if you had invested in the peak around 1998, you would have taken 13 years to get your money back. And if you had inflation, that was almost 20 years.
Yeah.
There's still properties in America that have still not recovered from the 05, 06, 07, 08 crash. This happens. This happens.
I can believe it. Yeah. A typical bear market, this is kind of mind blowing, but a typical bear market wipes out 80 to 90% of value out.
Correct.
You know, and when you add in inflation, it could, I mean, I think that may be in inflation terms, but that is normal. If you know, people who are buying bonds at 1% are probably going to lose 80, 90% of their money.
Yes.
You know, if interest rates go back up to 12, 13%.
And the challenge with real estate, and again, there's nobody more bullish on real estate than me, since I was 14. But if you time it wrong, and let's say you put 20% down, which is typical, and you have an 80% debt, and that real estate falls, and I've been there where it falls 40, 50%, you lose everything.
Yeah.
You lose everything.
Yeah. If you bought an apartment in Tokyo in 1989,
yes, you
would lose 80% of your money.
Yes.
And I'm not sure it's ever going back.
Right.
I mean, they're not making any babies in Japan anymore.
Yeah.
Right. Yeah. So there's no one to buy this real estate. You can buy property in Japan for $1.
Yes.
Right. So real estate doesn't always go up.
Right. You got to time it right.
And so timing is important. You know, I think we talked about Cisco before, and you know, if you bought Cisco stock, you know, close to its high, and it's done incredibly well.
It's an amazing company.
Amazing company.
Yes.
It's done unbelievably well. You're still underwater.
Right.
You're still underwater today.
Yeah. And it's why I won't buy an NVIDIA. Like I wish I'd bought an NVIDIA, greatest stock ever, but I won't buy it now because I remember the 10 years of Cisco, which I held the great company because it did nothing.
Yeah.
So if you buy things, so what I know about real estate, all of money's made in the buy. And again, just a little bit more about real estate. I don't think your house is your best investment. So this is contrary to what everybody thinks. So for example, in 2020, virtually all real estate in Canada states, it was cheaper to own than rent because when interest rates are like 1%, 2%, it's cheaper to own. So real estate actually makes sense when it's cheaper to own than rent. But now virtually everywhere in North America, virtually most places in the world, but especially North America, it's cheaper to rent than own. That's not a good time to buy. So again, you've got to know the cycles. You have to understand the cycles.
I think that's a great point, right? Which is, how do you know that something is cheap?
Yes.
So let's talk about, you know, real estate well, right? So you mentioned one factor. There's
Huge
other
factor.
ones.
Yes.
One factor is rent to own, but there's other ones. How do you know real estate's cheap?
So I have a rule that I learned when I was 14 years old from Raymond Aron, and I look at it, and it's a very simple rule, okay? And it's never, ever failed me in many countries, many continents. So let's say property is worth $1 million. Right. If it generates $100,000 a year of gross revenue, I'll buy it, no matter where. Okay. So $1 million, that's cap rate. And it's never failed. So even if interest rates are 8%, I can still make money.
Okay. So this is still a rent buy kind of thing, right? Yes. What else? What else is, how else do you know a property is cheap?
Okay. The second way I've done it is I look at replacement cost.
Bingo.
So anytime I can buy real estate for less than my cost to replace it, I'll buy it.
Yeah.
So those are literally three rules I have.
That's a great principle. And that applies to stocks too, by the way, right? So there are a whole bunch of stocks right now that are so unbelievably dirt cheap. Two sectors that I know of, one is biotech and the other one is gold mining, that are unbelievably cheap. Like the replacement value is so much higher than what the stocks are trading at. In some cases, like these companies have even more cash per share.
Yes.
Than the stock price.
Yes.
I remember, so one of the smartest things I did on that front. So on 2008, I mean, it looked like everything was really falling apart. And it was. I mean, there was absolute mad panic.
Yeah.
What I did is I did a screen. I just looked for all the stocks that were trading at well below their cash.
Yes.
I just bought them all. I didn't even know what they were. Right.
Yeah.
Some of them went up 30x. There was a coal mining company called Yanzhou Coal. I still remember it. I bought it for $3 a share and it went up to $60 a share.
Right.
And it was just that everyone was dumping everything.
Yes.
Right? So I think it's really important to know what is cheap. The other one that I would use for real estate is looking at price to income. So one of the things about Canadian urban real estate, looking at Toronto and Vancouver in particular, you know, incomes are going up well less than the price of things. So
Yes.
the price of
It's
properties
shocking.
is huge,
Yes.
and incomes have gone up for
Yeah.
sure, but they've not gone up anywhere. So
Nowhere near.
So I think it's risky. Now, could it go up more? Yeah.
Yeah.
Absolutely. And I've made some mistakes by not buying real estate because I'm like, oh, it looks a little bit expensive. It can get way, way more expensive, right?
Yeah.
Than what it is. So I've made a mistake that way. And that leads to a topic I want to talk about, which is the importance of diversification and the
Yes.
importance of actually not making bets. Like you talked about, buying a coffee can portfolio and letting it sit for 10 years. Like, I think there's a lot of value in that. And if you have like the right sort of different asset classes, you're not trying to outthink the market.
Right.
I think that's actually a really important principle. But yeah, I mean, knowing what is cheap, like how do you know something is cheap? How do you know a stock is cheap? Well, we talked about one thing.
Yeah.
It's, if it's trading below its asset value, it's
Right.
cheap.
Right.
If its earnings are going up for a long time
Yes.
and it's not really priced in, there's value in that.
So Mark, when you talk about diversification, I want to give a story about why it's so important. So even if you're really good at something, like I was really good at real estate, and we had a year where we sold $1 billion of real estate, all of our investments, and I was telling my wife at the time, like, I know what I'm doing. Excuse me. We're going to put it all in real estate.
Yeah.
And then the 2008 crisis happens.
Right.
And then you just look like an idiot. So, and it's very painful. So even if you know a sector well, so for example, for you, SaaS or technology, you would never put all of your money in, even in a sector that you know really well, because when it goes down, it's really, really bad. And it could be for a long time. Would you agree with that?
Yeah. I mean, it can be 20, 30 years. It can be a long time. Like even, yeah, I mean, I could think of some sectors that, ones that I like. So I'm a fan of gold. I think gold is cheap. I think it's undervalued.
Yeah.
But if you bought gold in 1980 at $850, right, then it would have taken 25 years, I think, to make it back. So yeah, so I think the diversification thing is interesting. I mean, I got into my dad is really is a pretty good commodities investor, and I figured, since I make my money in tech, I want to learn this other side because it's kind of like anti-tech, right? Yeah. So I got interested in diversification that way. But then I read this white paper, it just blew my mind. It's called The Allegory of the Hawk and the Serpent. So it's a very colorful name, but it just blew my mind. And it changed my approach to investing. And what these guys did is they looked at the last 100 years and they looked at what kind of portfolio would allow you to make money in any time frame. Okay, so in the last 20 years, the place to be was stocks, but you know what? Not all part of the 20 years. So again, there's lost decades. Even in the last 20 years, there's lost decades in stock, especially in tech stocks. But equities has been a great place to be. Really since 1982, it was pretty good. There's some crashes along the way, but it was a great place to be. But what was even better in 1982 was bonds. My dad made a lot of money in bonds. Right. So he bought bonds at 18%, no risk whatsoever. Right. The Canadian government can print whatever they want. And then interest rates went down to 1%. He's still getting paid 18. Right. Right. And very few people were buying bonds back then. In fact, they were called certificates of guaranteed confiscation. Right. Because you're like, well, we all know inflation's going up forever. In the 70s, inflation went up like crazy. We all know it's going up forever. Where do you want to be? Oh, you want to be in gold. You want to be in farmland. Well, you would have lost your shirt. Right. If you put all your money in Krugerrands back then in farmland, you would have lost your shirt. If you put your money in the one thing that everyone said you're a moron for investing in, you would have done very well. And the same thing, stocks, you would also do very well. I mean, these stocks at that time were paying 15% dividends. Yeah. These days you can't sniff a dividend anywhere, right? So these guys looked at that and found the optimal portfolio so that you make money in all time frames. And it's actually very interesting. Most North Americans are way overweighted in equities. And equities includes real estate for these guys. Anything that is essentially linked to the stock market, which real estate is. So most people are like 80 to 90% weighted towards equities. And why wouldn't they? It's been going up like crazy for 20, 30 years. But you may be cruising for a bruising on that, because what we just said, what was great in one decade often is the opposite. It's the opposite in the next. So a lot of people have way too much there. They're waiting for real estate with something like, for equities with something like 20%. Right. And so the other thing that did really well would be 20% in commodities, which these days people don't have a lot in that. So those are things like energy, metals, food, that sort of thing. And so that's another bucket, right around 20%. 20% in physical gold, that is way higher than any investment advisor would ever recommend, right? They often recommend 5%, 10%. What they found was the right number was 19%. It wasn't 20, but close enough. 20% in physical gold. Again, if you had gold in 1930s or in the 1970s, you crushed everybody.
Right.
Okay. Your gold went from $35 an ounce to $8.50 an ounce in the 70s. Yeah. And same thing in the Great Depression. Essentially, gold was cash because there was no dollar. It wasn't a fiat dollar at the time.
Yes.
So if you had cash, you could buy anything you wanted at the time. So you did very well in that. And then the other category is fixed income. And so again, fixed income today doesn't look like a very great idea, better than it was a few years ago. At least now you get 4 or 5%.
Right.
But with all this money printing, it doesn't look great. But the one thing that they recommend in this white paper is don't try to outthink the market.
Right. It's not going to work.
And it's hard to resist that temptation, right? I personally think physical gold's going to the moon, but you got to resist that temptation. You got to say, you know what? I got to buy stocks that I think stink. I got to buy bonds that I think stink, because it's that portfolio that does well. Now, this other category is these guys sell instruments that are tied to volatility, so that when volatility goes up, that these instruments go up. That's kind of what these guys are selling. So I'm not so sure about that. I did dabble in this for a bit. And even though we had quite a bit of volatility in the last few years, I didn't make any money with it. Yeah. So I've just got rid of that. And so now I think it is 40% equities, 20% fixed income, 20% commodities, 20% bonds. And then within each category to have diversification. So like bonds, you can buy you can buy Federal Reserve, not Federal Reserve. You can buy treasuries in the US. You can buy Canada savings bonds, but there's also municipal bonds. There's company bonds. Like you can get all kinds of diversification in there. Diversification in equities, even diversification in gold to some degree. There's different forms of it, and whatnot. So if you have those different categories, and within each category of diversification, you basically have a bulletproof portfolio that will do well in any time frame. Even if you have like a war or something that wipes out bonds and your stocks, you still have energy and gold that can go to the moon in that environment.
So I think it's pretty safe bet talking about a diversified portfolio. Yeah. I can tell you about the last 10 years for me where I wasn't really actively working and my investments were really funding my lifestyle. So I took big bets. Yeah. And even if you look at like Warren Buffett, he doesn't have an equally diversified stock portfolio. There's like 7 or 8 companies and like half it's an Apple. So sometimes when you're 100% convinced of something, you got to go take the bet. Yeah. So, and what I found is when I get too fancy, it doesn't work. So for example, I've been a big Apple fan forever. And I remember about 8 or 9 years ago, I had this fancy broker, of course they take you these fancy lunches and all these things. And I said, I just want to buy Apple stock. He said, well, there's a better strategy if you want to buy, we're going to buy call options. And it's a very fancy thing. Anyways, it turned out to be absolutely the stupidest thing I've ever done. I would never buy. Now, luckily, I didn't take his advice on other things. So I put like the kids' money in Apple stock and other things, and it's done incredibly well. So I do think that knowing a bit about the company, so I'll only want to invest in companies I understand Apple and I understand Tesla and I understand Netflix, like things that I understand. I think that it's not a bad idea, but if you know nothing about that company and you don't understand some weird structure they're pitching you, it might not be a good idea.
Yeah. So what I say on that, right, is to have a chunk of your portfolio that is allocated towards riskier bets. You said things that can make you a big return, because I think the previous principle was unless you've got some real inside information, it's hard to outthink the market. It really is. Agreed. So I think you want to have that diversification. But that said, some of the best returns I've ever had was in venture. So I invested in an Indian seed venture capital thing that generated 8 times return in a few years. And maybe I got lucky. I don't know. But my thinking on that was that, India is kind of like counter-cyclical to the US. Yeah. And I went to India and I could just see, wow, there's
It's
a lot
incredible.
of wealth that's building.
Yeah, it's
honestly,
the new China.
You really can't miss betting on the Indian consumer.
No,
I mean,
you can't bet.
She just gets richer every year.
Yeah. Any bet on India the last decade is absolutely right. So a couple of things. If you're going to make a big bet, I'll just tell you a couple of warnings. Yeah. Your friends and family will tell you not to do it. Yeah. So I found a small town about, 6 or 7 years ago in Northern Ontario, really far north. Yeah. And I decided to go in and buy as much real estate as I could, because I found houses I could buy for $75,000 that if I had to rebuild them, it cost me $300.
That's great.
And I did all the math on it. And everyone said, Roman, that's a crazy idea. No, it was the best single real estate investment I made my entire life. Like, I've never had those kind of returns. So I look at certain ones that have like a 5X, because if I'm going to take that risk, I want a big return.
But I see, you know what I think is that wasn't risky at all, right? So, so you mentioned Warren Buffett, his mentor is Benjamin Graham, and The Intelligent Investor. Everyone's got to read that. Everyone's got to read that book. Yeah. I think the most important principle out of that book is the margin of safety. So your margin of safety was so high. If you're buying houses for 75 grand, it's hard to lose too much. And I remember, so I had the same situation, but I didn't do what you did. So I had a friend of mine call me up in 2008 and says, hey man, I'm buying houses in Detroit and Cleveland.
Right.
You want in with me? Yeah. And I'm like, so I go on the internet. Yeah. I look at these places in Detroit and oh my God, these are crack houses. I mean, Detroit was falling apart in 2008, right? Yeah. Cleveland was falling apart. I'm like, this is crazy. He's like, yeah, but houses cost $9,000. Right. And, and they rent out for, $2,500 a year. Yeah. That math is pretty good. And honestly, I should have gone in on that, because I would have made probably 5-6 times my money. Yeah. Well, listen, I'm doing it again. There's another town about to announce some things, so I'm going to do it again. But what I do know is don't listen to friends and family. Yeah. And sometimes who we respect. So for example, and here's an example with us, during the pandemic, I knew that real estate was going to crash. And I started selling aggressively as much as I could. Yeah. And I was investing in Bitcoin. And you were like, Roman, don't do that. Sometimes you've got to, and all my friends have found like, Roman, you're insane. Like you're a real estate guy your whole life and you're putting this thing as crazy Bitcoin. I mean, now it turns out to be right. But at the time it was insane. Yeah. So sometimes if you really, but I did the research. So I didn't do like an hour of research. I spent 1,000 hours. And I actually thought Bitcoin was a scam for 10 years. Like literally for 10 years, I thought it was a joke. So I think that we all have to do our own research. And sometimes you make a bet and sometimes you win, sometimes you lose. Well, I hope you're selling some of that Bitcoin. But yeah, I wouldn't call it a scam, but I do think it's a bubble and it's a massive one, right? So I got into Bitcoin actually really early, like earlier than probably anybody listening here. $3.13 was my first Bitcoin I bought. And it was because a gold dealer, so I buy gold regularly. And he said, you got to check out this Bitcoin thing. It's like digital gold. And I looked at it and it was really interesting. Like you can see it literally, Bitcoin is modeling gold. It has a lot of the same, as many of the principles as possible. Yeah. The big difference is that it's not a proven store of value, but a lot of other things, it's divisible, it's portable, it's not really untraceable, it's pretty traceable. But I did end up selling most of it. I still have some because I think there's a very small chance that it ends up being worth something, but more likely, I'm a big fan of learning about bubbles. So there's a guy named Charles Mackay who wrote a book called Popular Delusions and Madness of Crowds. Everyone should read it. Warren Buffett's a big fan of it. Which talks about sort of mass delusions of history, which include these crazy bubbles. Sure. Tulip mania, right? Yeah. And the South Sea bubble, the Mississippi bubble. I think if you actually look at Bitcoin and how the mechanics of how it works, the mechanics of what's driving the price up, it's a lot like the John Law and Mississippi bubble, because they're printing tons of tether. Tether's used to buy Bitcoin, right? And then you've got like goof-offs like Mike Saylor, who's like, I'm going to go and borrow a bunch of money. I'm going to buy a bunch more Bitcoin and try to pump the price back, try to pump the price up. It really looks a lot like a bubble to me. So I would just be careful. And I've made money trading Bitcoin. It's actually not a hard thing to trade. Yeah. It has very predictable patterns, but I'd be selling aggressively right now. You know how you can tell, right? Is that stonks are really high, right? So Bitcoin's supposed to be a digital gold, but it doesn't trade like gold at all, right? It actually trades like a stonk. sorry, and stonks mean like stocks are just kind of like Nvidia and whatever. It just goes up forever. If you've got the NASDAQ really high and you got the Bitcoin really high at the same time, like a warning sign should be going off in your head saying, I should take some chips off the table. In which case it's okay.
So what's great about investments is you can make a lot of bets and sometimes we're right, sometimes wrong. So in this one, I'm all in on Bitcoin, and I actually think it's going to double this year, and it'll be worth $1 million in 5 years. Again, different theses, different, and we both could be wrong, could be right. It doesn't matter. But the point is, don't put all your eggs in one basket.
That's for sure.
Because when you do, you're in deep trouble. A couple more things I wish somebody had told me years ago, and I'm trying to explain this to my kids. I wish somebody had told me that instead of buying all the Apple products that I had bought, which I've spent a fortune on Apple, just buy the shares. Now I bought the shares way too late. Like I wish I'd done it a long time ago. So for example, if you had just, instead of buying the new iPhone every year, if you'd taken the exact same dollars since 2017 and invest in Apple shares, because they've gone up so much, and if you look at what's happened, it's worth millions of dollars. So that $20,000 would be worth $3 million. And the same with Tesla. I'm a huge fan of Tesla. I've had 3, but in 2014 when I bought my first one, if I'd taken that $100,000 instead of buying the car, bought the stock.
So what do? You drive a Corolla and just buy the Tesla stock?
Maybe. But I think that, but it's also the same thing with home ownership. It's like, I think right now it's better to rent than own.
I agree.
Right? So there's different things you got to look at it. But I think that when you really are passionate about a particular company, sometimes ease off the product, buy the stock, and you'll be much happier.
Okay. Yeah. Again, you still want the product, but yeah, I think if you do invest in what you know, and ideally have proprietary knowledge, like you have inside knowledge of something, which is hard to get. Again, it's hard to beat the market. But if you have some insight that others don't have, like you mentioned, I think before the show about investing in Snapchat because the kids are on it. I think that's a great investment thesis.
Yeah.
I think honestly, studying what kids are interested in, because now you might actually have some proprietary insight on things. Like I think that's actually
watching our kids. I mean, to me, watching their devotion to Apple products, how much time they spend on Snapchat, or our whole family, how reliant we are on Google. Like right now, there's some dips on Google. I think it's an opportunity. So anytime you see like great companies with have some conditions that are not favorable, might be a good time to add some more shares to them. But look at what we're using every day, because the reality is the Magnificent Seven, they're probably going to be there in 10 years. And if you're betting on Magnificent Seven and they're taking dips, might not be a bad, might be a good investment.
Yeah, it might be a good investment. I still think that if you want to buy things that are really cheap, those are not tech stocks, even with a dip.
They're not cheap. They're not cheap.
Again, you might have a 10% dip or 20% dip, and that sounds like something.
Yeah.
But when things get hit hard, think about just recently, right? In 2020, I mean, things got hit really hard.
Yeah.
And a lot of people got smashed by buying on dips. The dip you wanted to buy was 50% down.
Yeah.
So again, I mean, in equities, I'd really be looking at things that are really, really beaten down. These days, a lot of these are commodity producers, which
REITs. There's some REITs that have been really beaten down as well.
Yeah, and they should be though too. Like I think commercial real estate is in trouble.
Yeah, it's a 50% off sale right now.
Yeah, and that's a it's interesting bet. How much of work from home is reality and whatnot. But there's something called the commodity cycle, which is and this is a really easy thing to invest in. And you may have heard the phrase, the best cure for high prices is high prices. The best cure for low prices is low prices, right? So when the idea here is that commodity prices are actually pretty low right now, and that's why all these farmers are going out of business, left, right, and center.
Right.
Miners are going out of business, all because these commodity prices are not high enough, but the cost of labor has really gotten up. I mean, when's the last time, who wants to be a mining engineer these days? Who wants to be a farmer engineer? I bought a farm 3 years ago. The average age of the farmer that I was looking at buying a property was 80.
Wow.
So no one knows how to farm anymore.
Right.
No one knows how to mine anymore, but that's an opportunity.
It is an
right?
opportunity.
Because what it means is that, these commodity prices have to go up.
Right.
The price of energy, the price of food, the price of metals,
whatever
has to go up until one day when you look on the cover of Time magazine and there's a farmer on it or there's a miner on it.
Yeah.
And when half of the MBA class wants to go into commodity stuff, which happened. So believe it or not, I know it's hard to believe, but in the late 70s, people didn't want to go into investment banking.
Right.
They didn't want to go into be a McKinsey and Bain guy like I was.
Yeah.
Right. They're like, this is where to make the money. We're going to make the money by producing commodities. They never go out of style. Everyone needs them all over the world.
Yeah.
But so it's a contrary indicator.
Yeah.
Right. And so I think the mania in stocks, and I would include Bitcoin. I think the mania in Bitcoin is a contrary indicator.
Yeah.
I think everybody's warning sign should be going off. And you're right. Could you make more? Yeah. So the price of if we went to Tulip Mania, the price of Bitcoin would go to 750,000.
Right.
I totally think it could happen.
It could happen.
I'm still not buying.
Yes. Yeah.
I'm still not buying it because I think it's a bubble.
Right.
But could it go up a lot more?
It could.
Isaac Newton lost his shirt in the South Sea bubble.
Yeah.
And this guy, first of all, he was the smartest guy on earth at the time, and he ran a Royal Mint. So he knew all about money. He knew all about bubbles. He actually got into the South Sea bubble and got out. He made money. The same way you haven't sold Bitcoin yet. You gotta sell some.
Yeah.
Right. So I bought at $3. I sold at 600.
Yeah.
Right. But let's say I got back in. That's what Newton did.
Right.
Let's say I got back in now. What's it? 60 grand? 65 grand?
68,000.
68,000.
Yeah.
So I got in at 68,000 thinking that, so that's what he did.
Right.
He lost at the time 4 million pounds, which was a massive fortune back then.
Yeah.
And what he said was, I can calculate whatever it is, the distance of the heavenly bodies or whatever, but I can't figure out the madness of men.
Right.
So people every now and again go delusional.
So to summarize, I think the key that we both learned is contrarian thinking. So in real estate, when everybody's buying, you should be selling. When everybody's selling, you should be buying. And it's like that with anything. So I think the contrarian thinking works really, really well for investments. So that would be my one takeaway.
Yeah, easy said, not always easy to do.
It's hard because when all of your friends and family are saying you're crazy, and your kids are saying you're crazy, Dad, it's hard. It's hard to make these bets sometimes. But I think if you've done your research and you really believe in something, you got to take the bets. They're not all going to win, but at least we did our best. And that's what I think that's what we're all supposed to do.
Yeah.
Give it our best shot. So we thank you so much for joining us today on the Best Half Show, the #1 standing podcast. If you would like to give us a comment, we will. We're promised we're going to commit to getting back to everyone's on our comments.
Yeah, we'll get back to everyone. But some of what we talked about today. So we talked about the Intelligent Investor, Benjamin Graham. This ebook that I talked about, the allegory of the hawk and serpent. We'll put that in the comments.
Good.
Yeah.
We'll share that. So thank you so much for joining us. Have a great day.